This is the VIX. Here's 2 standard deviations. Here's 3 where we are right now. And we are not anywhere near the agony of crisis. Bob Sinche, do you predict that we will move away from that and find market stability in the coming 2 weeks?
Good morning, Tom. You know, I think there is certainly a case to be made for stability. You know, you and I remember the October 1987 stock market crash, which, by the way, if it was the same percentage decline yesterday, the S&P would have been down 565 points. So 113 is big, but it's not 87 type levels. But back then, we had something called portfolio insurance, which is a quantitative product that was put together to basically reduce equity exposure as prices went down and increase it as prices went up. Well, of course, that's a leveraging tool in terms of rate of change. You know, now I think we have these risk parity models that have been developed, and basically they are designed to increase risk when volatility is low and decrease risk when volatility picks up. Of course, the models are based on sort of gradual changes in volatility. They're not designed to deal with these kind of jump conditions. And I think what's happened in the last couple of days is the rise in wages that we saw last Friday in the employment report has triggered some expectations for higher interest rates, discounted into the equity prices. And then I think that's triggered some of these risk parity models to begin to reduce exposure, and it's fed on itself. So
I don't want to pick Bob on Ray Dalio, but if we look at risk parity models, you've been through this before where life goes on, but the product du jour gets crushed. Are you suggesting that we will see carnage within hedge funds and the ETF products that are part of this new short vol religion?
You know, I certainly when you get market moves this big, there will be people who get hurt, and certainly those who are dealing in these risk parity models, you know, may find it difficult to adjust as quickly as they would like. We have some guideposts here. You know, the S&P went down and hit its 100-day moving average yesterday, which comes in at 2633 and change. You know, that's a big level of support that we saw during all of 2017. If we can stabilize there and volatility start to come down, then I think things will stabilize as we go forward in the next week or so. If not, then we probably go down and test where we did in November of 2016, which is down to the 200-day moving average, which is another 100 points down, which isn't all that much these days.